Hello. In today's seminars, I noticed there's some confusion about how to understand the relationship between overpricing and underpricing of a security when you use capital asset pricing model. So here I decided to run a short videos to explain this in two different ways. The first way, of course, is from the capital asset pricing model um, conclusion where we have this called security market line. So it actually showing the relationship between the expected return and the beta relationship. The higher the beta, the higher the return, and all the um, security in equilibrium, the returns should lie in this line. So here, how can we use this? There's one crucial step here is saying that okay, if we are analysts, try to pick up a stock, what we do is we use a capital asset pricing model to estimate the fair value for a stock given in a way that its risk portfolio. For example, this particular stock, its fair value should be here. This is the expected rate of return, and if then we use our kind of financial statement analysis to actually evaluate and then calculate the return actually expected. So this return again is come from another estimation, but it's not based on capital asset pricing model, but based on other informations, your unique analysis. And if a stock unique analysis actually show that it's gonna earn higher return than its risk-adjusted return, then this is a stock have a positive alpha in the future, right? In the future, we expect it's gonna earn a positive alpha, then this definitely is a good stock to buy. It means this stock is undervalued, so that if we buy this stock, it's gonna generate us a higher return. So a positive alpha, it means it's undervalued, and we should buy a stock with future expected positive alpha. Yep. So this is from the security market line point of view, and as I said, you just think about from a buyer point of view, and this alpha is for the future. Then you can think about you want to buy something gonna give you extra, so higher alpha. But we can also think this actually in a more fundamental way, because there's another explanation saying that if the forecasted rate of return is lower than the expected rate, let's say in this context, let's say higher, because we're gonna say that the because there is general alpha, so the future expected return is going to be higher than the required rate of return. In that case, we will, if we look at the pricing formula here, so the future return actually is going to turn out to be higher than the model says. So what happened to the value? If we have a higher discount rate, that means the higher return than the model, then this current value will be lower than the fair value when this discount rate actually is lower, right? So a higher expected future return means the current value is lower, so means higher, larger positive alpha means lower valuations, holding everything else constant. So that these two things connect. I hope this actually help you understand the calculation. If you don't still have questions, come and ask me.